the dollar just crashed to 99, a brutal 5-week low that's sending shockwaves through every market on the planet. The 10th of December 2025 today. The Fed's long-awaited 0.25% rate cut slammed the button this morning, weakening the USD index by another leg down. A full 7% year-to-date bleed that's got central bankers sweating and investors scrambling for the exits. But here's what froze me in place this morning. Staring at the Bloomberg terminal with my coffee going cold, silver didn't just rise. It exploded to a record $61 an ounce, shattering every historical benchmark in a single savage breakout. That's 102% year-to-date gains, the hottest run since the Hunt brothers turned metal into mayhem back in 1980. And while the headlines scream about dollar panic, something far more sinister is unfolding beneath the surface. COMEX vaults are hemorrhaging 37.6 million ounces vanished in just 47 days, the largest drain since that fateful year when silver hit $49 and nearly toppled the futures market. Why now? Why with the dollar in freefall? My theory, pieced together from months of digging through public reports and cross-referencing COMEX filings, is that this isn't random volatility. It's stage 3 of a 4-stage pattern that's repeated like clockwork through every commodity crisis in history, from oil embargoes to palladium squeezes. The Fed cut was the spark, igniting a USD panic that's accelerating the breakout, and silver's $61 high is just the opening salvo. We're deep in the squeeze, where paper promises are crumbling under physical reality, and stage 4, the full eruption could catapult prices to $100 by summer, leaving latecomers in the dust. You still have a choice in this chaos, but the window is slamming shut faster than the dollar's value. Before we plunge into the heart of this panic, let me be upfront. I'm not a financial advisor, and nothing here is financial advice. This is purely educational analysis drawn from publicly available data like COMEX warehouse reports, Silver Institute forecasts, and Bloomberg terminals. I've pored over these numbers, connected the dots, and what emerges isn't hype. It's a relentlessly predictable machine that's about to grind the global economy if you're not positioned right. Let me lay out the 4-stage pattern that's haunted markets for centuries, because once you grasp it, you'll see why today's dollar crash and silver breakout aren't isolated events. They're the brutal convergence of monetary debasement and industrial desperation. This framework isn't my invention. It's etched in the scars of history, from ancient grain famines to modern metal manias. Stage 1 is complacency, the setup where abundance breeds arrogance. Think post-World War II America, oil gushing cheap at $3 a barrel, or silver lingering in the shadows after the Hunt collapse in 1980. Authorities flood the system with paper proxies, futures, contracts, derivatives, ETFs that dwarf physical supply. For silver, this kicked off hard after the Hunts tried to corner the market. Regulators, spooked by the volatility, unleashed a paper monster, a futures market estimated at 50 times the size of actual vaulted metal. Open interest ballooned to 244% of COMEX vaulted silver, meaning for every real ounce, there are over 2 paper claims floating like IOUs in a casino. Everyone trusts the system, because prices stay pinned low, suppressed under $30 for a decade post-2008, while the world pretends supply is infinite. It's the calm before the storm, where debt printers at central banks crank out trillions, and no one questions the fragility. Stage 2 is expansion, the surge where cracks widen but no one screams yet. Global central banks unleashed over $30 trillion since the financial crisis, with the Fed alone ballooning its balance sheet by $8 trillion. Promises stack on promises, more debt, more derivatives, more paper silver traded than ever mined. Industrial demand creeps up quietly, solar panels needing silver paste for conductivity, electric vehicles guzzling 3 times the metal of gas guzzlers, 5G towers and AI data centers demanding purity no substitute can match. By 2024, industry chewed through 59% of total silver consumption, up from 40% a decade ago, while mine production flatlined, declining 7% since 2016. That's a structural deficit, 149 million ounces more consumed than mined, the 5th straight year, according to the Silver Institute. Yet prices, still leashed, thanks to banks flooding shorts and derivatives to cap the upside. We're living the expansion now, but with the $99 crash today, the leash is fraying. Stage 3 is the break, the squeeze where reality bites back. This is us, right here, right now. Physical demand erupts, India's imports hit records, China's state hoarding accelerates. Even South Korean banks halted sales indefinitely back in February. COMEX registered inventories plummeted from 80 million ounces in October 2024 to just 43 million today, less than 3 weeks of global use. Backwardation grips the market, spot silver trading above futures. People paying premiums for metal now over promises later. That's not greed, that's panic, the raw terror of illiquidity. The CME outage on November 28 lasted 10 hours, spiking silver to $56.72 before spreads blew out over a dollar wide. Lease rates hit 30% annualized in October. Borrowers desperate enough to pay usury just to touch physical bars. And JP Morgan? They've quietly amassed 675 million ounces since 2011, 45% of above-ground supply, reclassifying 13.4 million from deliverable to eligible right as demand peaked. Why? Because the gap between paper and physical has never been wider, and Stage 3 is where shorts get crushed as everyone demands delivery. Finally, Stage 4 is eruption, the panic where prices don't climb, they detonate. Trading halts cascade, delivery failures force cash settlements, premiums soar 30 to 60% over spot as physical vanishes. Institutions like JP Morgan, positioned long, reap billions while retail scrambles for scraps. History shows it. 724% surges, economies kneecapped, wealth transferred from the complacent to the prepared. My theory? With the dollar at 99 and the Fed's cut fueling this USD panic, we're not just in Stage 3, we're accelerating toward 4. The math is merciless. Consumption outpaces production, inventories evaporate, and no amount of printing fixes geology. This pattern has never failed, and today's breakout is its latest echo. But to truly see why silver's $61 record feels like the calm eye of a dollar storm, let's rewind to the lessons etched in blood and fortune from crises past. Take the Hunt brothers, Nelson Bunker and William Herbert, two Texas oil tycoons who stared down inflation in 1979 and bet the farm on silver as real money. It was Stage 1 complacency at its peak. Silver trading at a laughable $6 an ounce. Inflation raging at 13%, after Nixon severed the gold standard in 1971, turning the dollar into pure fiat fairy dust. The brothers saw the setup, the paper markets bloated, physical vaults full but ignored, and they pounced. They didn't nibble. They devoured 200 million ounces, 1/3 of America's entire supply at the time. Half in physical bars, half in futures leverage. Stage 2 expansion played out as demand surged quietly, industrial uses ticking up while the Hunts buying propped prices from $6 to $10 by late 1979. But by January 1980, Stage 3 broke wide open. Everyone realized, simultaneously, there wasn't enough metal to cover the paper flood. The Hunts demanded delivery, draining vaults dry, and silver rocketed to $49.45 and 724% eruption in 12 months that made them America's richest men overnight. Wall Street panicked. COMEX vaults emptied as the brothers controlled more silver than entire nations. The exchange, cornered, invoked Stage 4 desperation. They changed the rules mid-game. Silver Rule 7 banned new long positions on January 7, freezing the Hunts out while prices still climbed. Then, on January 21, margin calls tripled overnight, forcing liquidation. March 27, Silver Thursday. Prices cratered 80% in a day from $21 to $10, wiping $1.7 billion from the brothers' empire. They declared bankruptcy, brokerages teetered, banks froze credit for 48 hours, the system nearly imploded. But here's the gut punch, the lesson that haunts me. Those holding physical silver didn't lose a dime. Bars in hand, safe from paper traps, they rode out the chaos with metal still 66% above entry. The Hunts failed on leverage and futures. Physics doesn't bend to rules. You can't rewrite ownership of something you can touch. Fast forward to the 1,970 seconds oil embargo, another masterclass in the pattern's cruelty. Stage 1 complacency ruled from 1,945 to 1,970. Oil at $3 a barrel, gas 30 cents a gallon, powering the post-war boom on endless black gold. No one explored aggressively, supply seemed infinite. Then Stage 2 expansion hit as Europe rebuilt, suburbs sprawled, car ownership exploded, demand quadrupled while U.S. Production peaked in 1970, new fields like the North Sea years away. Prices crept up slowly, but the inelasticity geology's slow grind widened the gap. Stage 3, recognition detonated in October 1973 with the Yom Kippur War and OPEC embargo. It wasn't just politics, it was the brutal dawn that cheap energy was dead. Gas lines snaked for blocks, production stalled, prices quadrupled in weeks to $12. Stage 4 panic ravaged the decade. Oil hit $35 by 1980, a tenfold surge that ignited double-digit inflation, kneecapped central banks, and plunged economies into stagnation. Powerhouses like America, with the world's reserve currency, queued for fuel like rationed bread. The lesson? When structural deficits meet sudden awareness, price dislocation doesn't adjust, it destroys access, turning abundance into agony for the unprepared. Now, pivot to palladium in the 2000s, a more financial echo of silver's dual soul as money and tech essential. Stage 1, the 1,990 seconds, cheap and boring at $500 an ounce, ignored as a platinum byproduct. Stage 2, surge came with global emissions regs tightening, palladium became the catalytic converter king, demand exploding while supply, tied to Russian mines at 40% of global output, stayed stubbornly inelastic. Deficits piled for 8 straight years, inventories evaporated quietly. Stage 3 hit by 2019. Markets woke to the void, physical decoupled from paper. Russia delaying shipments with zero incentive to flood. Prices spiked violently. Stage 4. Eruption peaked in 2020 at $3,000, a 6-fold leap in 4 years, forcing automakers to swap to pricier platinum at efficiency costs. Paper traders holding futures got eviscerated when delivery failed. Physical holders cashed in generational windfalls. 3 crises, 1 machine, complacency yields to surge, recognition triggers squeeze, panic detonates everything. Physical endures, paper evaporates. And as we'll see, silver's dollar-fueled breakout today is this pattern on steroids tech convergence, amplifying monetary panic in ways history never saw. Applying this framework to silver's $61 record amid the $99 crash feels like watching history rhyme in high definition, but with a twist sharper than any past crisis. We're not just repeating the Hunt squeeze or oil embargo, we're amplifying it through the Fed's cut and USD's freefall, where monetary debasement collides head-on with industrial famine. Let's drill into stage 3, the break we're living breathlessly right now, because the data pouring in today screams that the squeeze isn't coming, it's here. Sparked by this morning's rate slash. Start with the macro spark, the Fed zero. 25% cut. The third this year, but signaling only 2 more in 2026, just hammered the dollar to 99.2, its lowest in 5 weeks and 7% weaker year to date. Bloomberg pegged the pre-cut probability at 87.2%, but the hawkish undertones Powell's nod to persistent inflation only fueled the panic. When the dollar weakens like this, hard assets like silver surge historically. But this time it's turbocharged. Gold's already at $4,216, up 55% YTD, but silver's volatility makes it the outperformer's choice, with our gold-silver ratio stretched to 7:2 from a historical 1:5 mean. Reversion alone math suggests $280 potential, but that's stage 4 talk. For now, the USD crash is draining liquidity from paper markets, pushing buyers to physical as trust in fiat phrase 54 years post-Nixon's 1,971 gold window slam, when dollars lost their metal moorings. Now, layer in the microcrush. COMEX, the future's heartbeat, is gasping. Registered inventories tanked from 80 million ounces the 1st of October 2024 to 43 million today, a 46% YTD evisceration, with 37.6 million ounces pulled in the last 47 days alone, the steepest since 1980's Hunt frenzy. On November 17, 6 million vanished in one day, a bank-run pace that has lease rates at 30% annualized borrowers paying extortion to borrow bars for hours. Backwardation locks in. Spot at $61 trades 30 to 40 cents above December futures, inverting the normal contango curve. That's not speculation. That's desperation. Signal of physical scarcity, where time value flips negative because tomorrow's promise feels like a lie. And the hoarding? It's global, feverish. 4 major South Korean banks suspended silver sales indefinitely on the 14th of February 2025. Not a pause, but a full stop. These unlimited capital giants admitting they can't source metal. China, hoarding state level with restricted exports and physical deposits required for futures, raised precious metals risk classifications, effectively sidelining citizens while state vaults swell. India's imports smashed records in 2024. Families who've weathered rupee crises, stacking bars as wealth shields. Even Russia, banned from London floors since April 2024, funnels output inward amid BRICS alternatives brewing. This isn't isolated, it's convergence. Industrial demand, 59% of consumption, is the accelerant. Solar alone. IEA forecasts 400 gigawatts installed annually by 2025, each megawatt slurping 20 grams of silver paste. No copper or aluminum submatches conductivity without efficiency craters. That's 200 million ounces yearly by 2028, up from 85 million in 2020, while EVs double silver per vehicle and 5G AI data centers demand ultra-pure coatings. Mine production? Peaked at 886 million ounces in 2015, now flat to declining as 70% rides as byproduct of zinc, lead, copper, base metal slumps starve silver output. Recycling? Pathetic under 20% recovery from electronics, too diffuse to scale. The Silver Institute clocks a 149 million ounce deficit in 2024. Fifth consecutive. Projected 118 million for 2025 consumption devours production. Inventories bridge the gap until they don't. JP Morgan's role? The quiet colossus. Since settling manipulation fines in 2010 for $200 million, inheriting Bear Stearns shorts in 2008, they flipped massively long, accumulating 675 million ounces by some estimates, 45% of above-ground stocks. Recent COMEX data, 169 million in their vaults, 40% of total eligible, with that 13.4 million ounce reclassification from registered to ineligible timed perfectly amid peak demand. Why hoard if silver's just industrial junk, as experts dismiss? Because they see the pattern, the paper edifice, 100 ounces traded per physical one, buckling under delivery calls. The CME's November 28 outage, blamed on cooling failure in trillion-dollar infrastructure, spiked silver $56.72 during 10 hours of blackout, spreads widening to over $1. Veteran traders know halts mid-spike mean big players are cornered. With $1.99 crash today, USD panic amplifies it all. Fiat flight to hard assets meets industrial famine, stage 3 squeezing shorts as physical premiums climb $3 to $5 over spot already. Dealers report delays, ETF inflows surge to 2011 levels. This is the break. The moment markets realize supply won't catch up. The Fed cut wasn't relief. It was the detonator, weakening the dollar to expose the fiat fragility since 1971, when Nixon's shockwave birthed endless printing. Silver's $61 isn't a peak, it's the floor of Stage 4's rampage. As Stage 3 tightens its vice with the $99 crash fresh in the rear view, Stage 4 looms not as possibility, but as inexorable math, the eruption where silver doesn't rise. It gaps violently to levels that rewrite portfolios and rattle governments. Let's map it out, because ignoring this is like pretending the Hunt brothers' Thursday crash was a blip. Projections from the street. JP Morgan's late 2025 call was $38. We're $23 past that already. Citi's 3.6 to 3.9 target? Smoked. Independent voices like Lawrence Lepard whisper $75 to $90 by N2026, conservative assuming paper holds. But what if it doesn't? The gold-silver ratio at 7:2 to 1 versus historical 1, 5 to 1 screams reversion, pure mean math, pointing to $280 if gold holds 4,200. That's not fantasy. It's equilibrium, when monetary bid meets industrial hammer. Cascade starts small. A solar giant like First Solar announces sourcing woes, triggering peer panic buys. Governments China, India, even the U.S. for defense missiles stockpile strategic reserves as BRICS eyes silver-backed alternatives to dollar dominance. COMEX halts trading like November's cooling farce become weekly. Delivery fails force cash settlements against will. Lawsuits fly as pension funds and sovereigns claw for bars. Premiums? From today's $3 to $5 over spot to 30, 40, even 60%. Remember 2020 COVID when $28 spot meant $45 coins? Scale that to $100 spot. Physical at 150 or more, dealers sold out, mints backlogged years. The paper market freezes entirely, contracts suspended, regulators probe as the 244% over-leveraged beast implodes. Shorts, banks, hedgers get crushed in billions, while early physical holders watch from bunkers of metal. This time's different, amplifying the panic. Tech convergence supercharges it. Solar's IEA trajectory, 400 gigawatts yearly, devours 200 million ounces by 2028. No pause button on net zero mandates. Europe's subsidies, China's retooling, U.S. IRA, trillions all policy ironclad. Demand destruction impossible without halting the green revolution. EVs, twice the silver of combustion, fleets mandating millions more ounces. 5. G and AI. Data centers alone could suck 50 million annually by 2030. Silver's conductivity, irreplaceable copper, oxidizes, aluminum lags. Counter the delusions head on. Substitution? The periodic table laughs engineer around silver, and efficiency tanks 20%. Costs balloon. Recycling? Under 20% viable from gadgets. Solar panels locked 25 years in fields. New mines? 7 to 10 years gestation. Grades declining globally. CapEx at multi-decade lows. Technology saves us? It consumes us first. Demand falls only if energy transition halts politically suicidal. American exceptionalism? The 1,970 seconds oil shock felled the superpower. Physics trumps passports. The USD panic at 99, post-Fed cut, exposes the fiat bill due 54 years of printing masked by CPI tweaks, now converging with silver's scarcity. Stage 4 isn't if, it's when the industrial bid exponential mandated slams the monetary flight from debased dollars. Prices gap. 50, 75, 100 inches, weeks, not years. Not prediction, supply-demand arithmetic in a bufferless market. So, with Stage 4's shadow lengthening amid this dollar crash and silver's breakout, what do? Not speculate on paper flips, that's the trap that gutted the hunts. This is about ownership, insurance against the inevitable. First, commit to physical-only no ETFs, with cash settle fine print, no futures leverage that evaporates in halts. Go for recognizable liquid forms. American Silver Eagles, Canadian Maple Leafs, 100-ounce bars from refiners like Johnson Matthey. Purity stamps anyone honors globally, resale seamless when premiums spike. Second, buy now, while the window cracks open, physical trades $3 to $5 over spot today. But in squeeze acceleration, that's $20, $30, $50 soon. Dealers like APMEX report inventories thinning. Delays hit weeks already. Strike, while premiums whisper before they scream. Third, allocate smartly, not all in recklessness, but 10 to 20% of your portfolio. Enough to shield if the pattern completes, balanced so surprises don't devastate. This isn't gambling, it's hedging the math we just unpacked. Fourth, store with control home safe for quick access, bank deposit box if trusted, private vaults for scale. Ditch third-party custody, the point is counterparty proof, metal you command, not promises from vaults you don't. Fifth, verify relentlessly, pull COMEX reports yourself, scan Silver Institute deficits, cross-check IEA solar math. Public data doesn't lie. Arm yourself with it to cut through noise. The choice is stark. Position for the thrive side of this wealth transfer, or watch from sidelines regretting the inaction 6 months from now when $100 spot means $150 physical, if you can find it at all. Every fiat's fallen average 27 years. The dollar's 54 deep. You can't print silver. Physics demands balance. If this resonates, if the patterns echo in today's USD panic clicks, hit subscribe. I'll track the breakout in real time. Drop in comments. Does silver hit 100 inches 2026? Your take fuels the conversation. And stick around for the next video, where I unpack the documented manipulation finds, shorts, the bank's playbook keeping silver cheap for decades. The clock's ticking. Don't let the dollar's crash be your wake-up call.